right, I think we're good for this morning. So good morning, everybody. Don Fall here, Mercer Partners. Happy New Year. Welcome to our outlook for 2026. We're delighted to have you. Probably more than any of the others with the workshops that we do, I enjoy this one. It's always interesting to look back a year or look back period and then look forward, especially with the year we've had. So we're thrilled to be here today. Thank you for joining us and giving us your time. A lot of you have been with us for most of our workshops and probably recognize John Tousley, so we're thrilled. He's kind of back by popular demand. Always enjoyed the commentary, so should be a good time this morning. A couple of housekeeping things. We are recording. We hope to have this available for follow-up use for others that were not able to make it today. So that is going on. Neither chat nor the Q&A are enabled for this session. We do want this to be very conversational, and we'll be taking questions and answers. So make a note, and you'll want to raise your hand for that, and we'll remind us as we get a little later on into the conversation. But today, we're hosted by your advisor team, myself, Nick Ensweiler, Chad Fall, and we're going to get going, and I'm going to have Nick get the program started.
Thank you, Don. Good morning, good afternoon, everybody. I guess depending on where you're joining us from, but we're incredibly excited to connect with you this morning and give some thoughts on the capital markets in the year ahead. And as Don alluded to, we are incredibly fortunate to have John Tousley with us today. He's our returning champion. Many of you may remember John from previous events that we've done, and as Don said, he's always in high demand, and so we're incredibly thrilled and lucky to have him here with us today. I'm going to try to give him a brief introduction. Probably doesn't do his CV justice, but John is he's at Goldman Sachs. He's a managing director in the Client Solutions Group. He really serves as the global head of market strategy in the Strategic Advisory Solutions team. Really, his role is to focus on the global capital markets and providing insights and strategies for folks like everyone on the call today. So, John has, I guess, you joined Goldman in the year 2000, so it's been over 25 years now. So, tons of experience when it comes to the capital markets and assessing what's kind of going on in today's landscape. He went to BYU University as a CFA charter holder, currently lives in Salt Lake City. But we couldn't be more thrilled to have John with us today, and going to turn it over to John for his prepared remarks. And, after that, we'll open it up to questions. So as John speaks, please have your questions ready, and we'll be sure to address them. But John,
Awesome.
take it away.
Yeah, thank you, Nick. I appreciate the kind introduction. Don, Chad, also thank you for your comments. I'm gonna pull my screen up and talk a little bit about how we think you invest in today's market. I think today's an interesting example. The tone of the market feels a little bit back like when we were in March and April, where tariffs and counter tariffs and just retaliatory comments all were being slung around. It's a unique world, and so I want to remind you that at this time, back in March and April last year, you probably did not expect the S&P 500 to subsequently set 39 all-time highs and recover 38% from the lows of uncertainty that we had in early April. I think it's an important reminder as we think about, just the easy headlines to look at right now: Iran, Venezuela, Greenland, NATO, market valuation, market concentration. And even last week I was in Minneapolis, and oddly enough, I get to throw Minneapolis in that group. That we have all these issues that are what I would call potential energy, in the spirit of physics. They are issues, it's like a rock at the top of a cliff. If it stays right where it is, it's not going to impact anything, but there's the potential for it to move up downhill. And if it does, it could gain significant kinetic energy. I think the kinetic energy that is currently actually happening that the market cares about would be a really solid economy, very robust earnings growth. And when I look at the recent economic data that has been coming in over the last 6 weeks, significantly better than expected. So the things that are actually kinetic energy right now, things that are in motion, things that are happening, are a really good economy, really good equity market, and really good broad economic data. That's what's in motion. And that's why sometimes you might scratch your head and say, how is the market doing so well? And the reality is it's anchored on these good fundamentals. If these good fundamentals shift, our growth goes down, our earnings go down. There's some, military engagement. Something shifts in terms of the, overall landscape. Then these things we currently worry about, these potential issues, Iran, Venezuela, Greenland, NATO, Minneapolis, valuation, concentration, and so on and so forth, those all will impact the market and start repricing the market. So as we are, I would suggest that the economy is the more powerful, more active event actually happening right now, and that is enabling the markets to, as a general statement, endure some of this uncertainty. It leaves us responsibly bullish. So if I think about, you can see this on the screen, our title, Responsibly Bullish. We think this is a calendar year where you're going to want to stick to the plan, stick to diversification, stay long-term in your focus, but there are enough potential issues that you're going to need to be responsible, better diversification, better hedging and risk mitigation strategies in your portfolio, maybe a little bit better liquidity. So there's things on the margin that you can do to recognize potential issues, but you want to stick with the plan because the kinetic issues are way more powerful right now. So let me jump through. I'll give you our forecast. And again, look forward to any potential questions or thoughts that are out there. I'll go for probably another 15 minutes. Now, the chart on the top right is our basic set of views. The light blue bars is how we anticipate we will end this year. The dark blue bars represent how we ended 2025. If you look, you'll see pretty decent symmetry. There's not a lot of change from one set of bars. And that just means that, again, I think we are late cycle in our growth, call it the seventh or eighth inning. That doesn't mean that the end is imminent. We can always go into extra innings, and clearly in the United States, cycles are getting longer. But we do, if you look at the first set of charts, we do expect the economy to accelerate. Now, there's a couple reasons we're accelerating in 2026. One is a mechanical issue. When you shut the government down like we did in the fall, that GDP doesn't disappear. It just gets delayed until you reopen the economy. So a lot of what was delayed in the fourth quarter of last year is going to start showing up in the first quarter of this year. That's some acceleration. We're going to get less, well, up until, Greenland tariffs, we thought we were going to get less tariff drag. So that's a moving piece right now. But as a general principle, we think we've seen the worst of tariffs, but every day that might change. We'll see how that plays out. But absent the Greenland-related tariffs, we would absolutely see less tariff drag on the economy. We're going to get a fiscal bump from the One Big Beautiful Bill. So if you take your eyes down to the chart on the bottom, if you see kind of that magenta purplish bar, that is the boost to the economy coming from the tax plan. And that hits the middle class mostly. The green bars, that's the boost from another factor, what we call financial conditions. And that is just, think of it as momentum. And you can see the dark blue bar, tariff drag, becoming smaller. And so as a general rule, we're about to hit or put a little octane on the economy in the first half of this year that should, see and propel the economy to grow faster than, we might actually see a 3 or a 4% GDP number in the first or second quarter of this year. I'm going to jump to the third set of bars, and I'll come back to labor in a second. Inflation will actually continue to move lower, and it'll get to about 2.1% at the core level. And that's kind of the sweet spot for the Fed. It actually, if you adjust for tariffs, would probably be slightly below 2%. So we have made it past the worst of the post-COVID inflation components, as well as the tariff inflation that we saw last year. Now, I would submit that the big surprises last year were probably not only that tariffs were deployed, but they were not as punitive to the economic growth as was expected, and that it didn't pass through to inflation as much as expected. During April of last year, we thought that inflation would come in maybe closer to 4% because of tariffs, and it actually came in at 2.8. Now, that's not just because the textbooks were all wrong. Part of it was some of the most aggressive tariffs that were suggested in April were never deployed. And then we did see, some deals get done. And so some of the tariffs were replaced with negotiated deals with Japan, with Europe, which look like they might be delayed for a little bit, with Korea, with Vietnam, with Brazil, with India. So some deals got done that removed some of the most punitive tariffs. So we expect tariffs to be less of a hit to the inflationary backdrop. Take my growth, take my inflation, and then that leads me to my fourth bar. Well, what's the Federal Reserve going to do about that? We think they are still positioned to ease interest rates 2 times. The market's priced for that. We think they're going to take their sweet time because the economy is doing pretty well, and they won't even start cutting interest rates till June. So we think we'll get a June and a September. The way I would contextualize these cuts, because a lot of people would say, well, if the economy is so healthy, why do we even need the interest rate cuts? And the answer is the Federal Reserve ultimately wants to get to a neutral position. And at 3.6%, policy is still a little bit restrictive. And so they would like to at least, think about it as the Fed's got their foot a little bit on the brakes. And the Fed kind of wants to just be in neutral. And so we think ultimately you'll get these 2 cuts, but there'll be no hurry to do that. Now let's jump back to this unemployment. So U3 is unemployment. The one major vulnerability we see in everything I'm talking about today is the state of the labor market. Now, I show you the labor market, which is currently at 4.4, remaining unchanged at 4.5. So kind of a flat unemployment rate. That's a little disingenuous, or not disingenuous, but kind of hides what's really going on in the labor market, because we are right now doing the opposite of what we did during the Biden administration. During the Biden administration, and because of those immigration policies, labor force exploded. And so my denominator got larger and larger. And so the unemployment rate went up from 3.3% all the way to about 4.1. And most of that was just because labor supply was up. We're seeing the opposite in the Trump administration, where labor supply is declining, again, mostly because of a reverse immigration policy. So even though the unemployment rate I show you here is flat, it's mostly because my labor supply is shrinking. And it's just hard to have the unemployment rate go up when my labor supply is shrinking. I think a better way to think about the state of the labor market, if you'll bear with me, I'll jump around, is a chart here on slide 7. And it basically shows, the chart on the right, when we came out of COVID, there were like 10 million people looking for jobs, but they had 16 million jobs to choose from. So I had a net, this peak right here represents, I had 6 million more jobs than I had people looking for work. Over the last 3 years, that excess of a job availability has diminished entirely, and we're now at the point where we've moved into negative territory. So even though the unemployment rate is at 4.5, and that's historically pretty attractive, we know that the last 3 years, the labor market has basically really slowed down hiring. And so you often hear that we're in a low hiring, low firing job market. If you have a job, you're probably fine. If you're looking for a job, it might take a while because there's not a lot of extra availability of jobs. Another way to look at this is the chart on the left. So the what I show you is basically help wanteds, which is the y-axis, and the help wanteds have declined. We're now kind of in this inflection point where any future reduction in the demand for labor means we probably move along the x-axis. That just means the labor market has moved to the edge of a cliff. If we stay right where we are, we stay right here in this inflection point, we're fine. Enjoy the view. But if we get any material additional reduction in the demand for labor, there's really only one place now for the labor market to go, and that's to the right. And to the right, as you can see, is a higher unemployment rate. So I would say as we think about our forecast and the things we worry about the labor market. It's one of those where it's like, if we stay where we are, we're fine, but there is this potential energy, this labor market at the edge of a cliff, and if the next step over the cliff could be very punitive. A couple more things, and then I'll highlight a couple charts, and then again, happy to go wherever Nick, Don, and Chad would like to take me. For the last couple of years, I've told you that the long end of the bond market is stuck, higher for longer interest rates. We still very much believe that. This is not because there's too much growth or too much inflation. It's because we have too much debt. And it requires, and this is one of the reasons you see the long end of the bond market selling off today, is because 35% of our deficit is funded by international investors. Well, if you tick off international investors, one of the mechanisms they have to express their displeasure with the United States is slow down their purchases. We can't afford to have them not buying our treasuries. And so the way that we attract them is we have higher long-term interest rates and more attractive interest rates than the rest of the world. Now they have to hedge their currency because they believe the dollar is going to weaken. We would agree with them. And they have to hedge their duration. And so after all these costs of owning treasuries, and now all the frustration maybe of owning treasuries, we think we have to have higher long-term interest rates for a sustainable period of time, like years and years. So we would expect these numbers to stay north of 4% for the foreseeable future. On the equity market, we take all of these things I've said, good growth, better inflation, hopefully a stable labor market, a Fed that's cutting interest rates, and we shake that all up, and that ends up as a pretty decent backdrop for equities. We expect equities to be up 12% this year, and almost all of it driven by earnings. So to put that in context, last year the S&P 500 was up 18%. The principal was up 16. We made 2 from dividends. Of that 16% principal appreciation, 14 of the 16 was from earnings growth. So it was really an earnings-driven market with a little bit of multiple expansion. This year, we think the same thing. We're going to be up about 12%, but we expect the entirety of that 12% to be driven by earnings, 12% earnings growth year over year. So again, market's doing relatively well. We're priced for perfection, but the earnings and the growth has been delivering to hold those levels. Couple things I want to highlight. The chart here on the bottom right shows you where tariffs have come from, where they ended, and we think they will actually move modestly lower. I am not going to die on this hill. This is if we all on the planet get along with each other. If we continue to use tariffs and we see counter retaliatory tariffs, I don't know exactly where this number goes. This will be a big issue for the market. Absent these current geopolitical events, we would say tariffs ultimately move a little bit lower, but that we're going to have to be on a swivel. I'd love to be more definitive for you, but clearly tariffs are reemerging as a potential source of volatility. Things that are really healthy about the U.S. economy, we're getting the fiscal boost. Our companies are incredibly profitable, and we're having major AI investment in the economy. About $550 billion just in AI investment. And these companies that are leading the market right now are have better return on equity, better profit margins. We are a very profitable, very dynamic economy. U.S. workers have like a Chinese worker is only 23% as productive as a U.S. worker. Our economy leads in so many particular areas that we should be able to sustain our economic advantage. A couple of thoughts about volatility. Uh, the table here on the bottom right, this is just a reminder that you have 250 trading days a year. And of those 250 trading days, believe it or not, so today's market is down a little more than 1%. Not sure exactly where we'll end up. I think we'll probably end up near our lows. I don't know so many people want to step in front of this uncertainty. But a day like today, you normally have that 62 times a year. To believe it or not, this is pretty darn normal, and the market's absorbing some of this uncertainty pretty well. You'll have 17 times the market sells off, maybe 2%. And I think maybe we get there today. It'll be a close call. We'll see. But the reality is, upwards of 100 times, you're going to have days like today, 1 or 2%. You'll have 7 times the market moves, plus or minus 3%. You can see the numbers. Just to put things in context, last year we had 55 1% days, 13 2% days, 5 3% days, 3 4 and 3 4% days, and 2 2% days. What I would say is, as uncomfortable as some of the volatility is that we had last year was very, very statistically normal. And in fact, maybe even a little less than normal. And a reminder again, today we have basically 62 days that are like today. Half of them are down, half of them are up. So digest volatility, it's part of the path of being an investor. Okay, we talked about labor. I do want to talk a little bit about inflation. When we look at inflation, the chart on the left is core PCE. You can see how high it spiked. It's come down precipitously as we've started to address some of the cost issues and the production issues related to COVID. We're now at this point where we have two paths. One path is the inflation that we're going to see as a result of tariffs. And the light blue path, the lower path, is what inflation would look like without tariffs. This is a very important, this deviation here is a debate that happens at the Federal Reserve. There's half the Federal Reserve that says, well, we should be paying attention to the dark blue dash line because that's actually the inflation we're going to see. And then you have maybe the doves, maybe those who align a little bit more with the current administration, who say, you don't need to worry about the dark blue line because it's temporary. And as we get into late this year and into early 2027, the lines come back together. Tariff inflation is mechanical. It's academic. It's a ledger adjustment. Tariff inflation is not this stuff we saw post-COVID where we didn't have enough supply and we didn't have enough manufacturing and we had way too much demand. This is the kind of inflation you need to fight. So lots of room for debate. I think you're going to see the Federal Reserve over the next 6 months actively, debate which one of these lines they should be following. What I don't think is going to be, up for debate is a chart on the right. And the chart on the right, as an economist, I look at the chart on the left and I will say, well, either way, tariffs or no tariffs, your inflation's looking better this year. Because as an economist, I think about inflation as rate of change. And basically I'm saying, well, inflation is getting better because it's not going up as fast. I think most of us as voters and as consumers are like, I don't think about rate of change. I think about price level. And the one thing I can't tell you is that prices are going down. I'm just going to tell you they're going to go up less fast. And so the chart on the right is something that gets to this affordability issue that is going to become front and center during the midterm elections. The light blue dash line is the trajectory that inflation was on until we hit COVID. The dark blue line is what the actual path of inflation has been as a result of some of the challenges of COVID. And again, the current administration said, listen, I'm gonna control prices, I'm gonna help prices get better. And what you can see is we have not seen the kind of price improvements that maybe voters would want to see. Not sure, but I will tell you that this is going to be more of a political issue than it is an economic issue. There is not price level relief, there's just rate of change relief. So we'll see how that gets navigated over the course of this year. As a general rule, we see global economies with positive GDP. We just lowered our risk of recession in the United States from 30% chance over the next year to 20%. Let me put that in context. The model will never go below 12%. So there is always at least a 12% chance of recession any given year. You would need the number to be probably 65 to 70% probability for a recession to be your baseline. So the fact that we're at 20, not 70, would suggest to you that we're probably only a third of the way there to having true recessionary concerns and fear. I think we're going to be just fine as an economy. The other reason I think we're going to be just fine is when we do look at recessions, we have a rich history of tracking what causes recessions. We used to have, and by the way, so there's 6 columns here, and these are the 6 major factors that have created recessions over the last 100 years. In the early 1900s, we had what we call fiscal events and industrial events. And by the way, the fiscal events, that's not tax plans. This is war. This is sending troops out. This is bringing troops home. It is the financial commitments to being in war. And you can see we haven't had a wartime-led economic downturn in 70 years. We haven't had an industrial downturn in 80 years. Last time we really had an oil issue was 25, 35 years ago. We've had the Fed become more prominent. And in our recent recessions, you can see the COVID recession right here, but our recent recessions have been more financial events. The housing crisis, the tech stock bubble, the S&L crisis. And so what I would suggest is when you are searching for recession risk, look for financial bubbles. That is in the US, in our modern, more diversified economy, that's the kind of risk we worry about. Any financial bubble popping. The reality is we don't have any systemic, highly levered financial bubbles. So we're going to have a lot of news flow. We're going to have a lot of problems. But if I could make one statement to you to take away from today, I would say this. Remember, the S&P 500 does not have the same anatomy as the economy. The economy and the stock market are different. The economy, the economic cycle, looks totally different than the news cycle. The news cycle is averaging about 7 days for an average piece of news. A political flub only lasts 3 days. Greenland will last a little bit longer, but we've already sort of moved past the Venezuela being the frontline story to other things. And so it's important to remember that as an investor, you worry a lot about things driven by the news cycle. And please remember the news cycle does not match the economy or the stock market. And so strive for patience with some of the uncertainty you get from the news cycle. One important thing to notice is that when we think about bubbles and things to worry about, I have the household sector. And, back in 2008, you can see the household sector got itself in a little bit of trouble relative to the government, the light blue line. In the last 15 years, you've seen a major difference. Households actually have demonstrated tremendous financial responsibility and balance sheet repair. It is governments that have taken off. And I would just suggest that while I don't like the trajectory of government liabilities, these can be financed in perpetuity. where households can't finance things in perpetuity. You end up running into a little bit of a wall. As much as I don't like the significant amount of sovereign debt in the United States, this is something that's not a clear and present danger. We can absorb it relatively well. So let me wrap up with a couple things here. We like our equities. We think bonds will trade relatively flat. We do believe the dollar will continue to weaken, and that creates a very interesting opportunity for global equities, global fixed income, gold and silver. These are all trading very much on concerns about dollar debasement, also threats to Fed independence, and also the fact that maybe our long bonds are not as cherished and favored from global investors as they used to be. I think energy prices, particularly oil, will stay lower. We think it'll struggle for about 2 years. And the real story in commodities is the precious metals and the base metals like copper. Think emerging markets will be very interesting if you had to add. And by the way, everything I'm saying right now, you have to run by your team. They'll know your personal investment situation better. But if you were adding to international equities, we think EM would be the first place to go. I know it's a little more volatile. We like the economy. We think their currencies are cheaper versus the dollar than G10 currencies. And one of the things I would highlight, whether you're in US stocks, small, large, mid, international, EM, private equity, the chart on the right just highlights that it's very important, and this is your 3 months rolling correlations. It's telling you that everything is not trading in tandem. Individual companies are trading based on individual company outcomes, meaning that it is profoundly a stock picker's market. You don't just buy anything and be happy with it. You have to be very specific. Pay attention to the companies, the industries they're in, their ability to defend their margins and protect their competitive position, their ability to compete on a global basis, particularly if their ability to compete should they be exposed to tariffs and what that exposure might be. This is an issue where we say micro matters. What I really should say is company specific issues matter. If you own great companies, you're probably going to be fine. But it's all about what you choose to own. This is not a market where you just buy anything and you should be fine. By the way, there are some markets that get like that. There are some markets where you just get invested and you're going to be fine. It's a rising tide. It's going to float everybody's boat. That's not the market we're in today. And then here's the last point I'll wrap up with, and then I'll turn it over to the team and thank you for your time. This chart makes me think about my career quite a bit. I've been involved in investing for about 35 years. So I started right about here. If you see my cursor, this is about where I started. This is the CAPE ratio. This is one of the more preferred ways of looking at the valuation of the stock market. And then we put a little dotted blue line across the 80th percentile. And what I'm basically showing you is that this line has been above the 80th percentile for the entire 35 years I've been involved in this business, except for a brief moment around 2008 and 9 during the global financial crisis. I have been talking about an expensive market for decades. And it's important for you to remember that, again, an expensive market is potential energy. It's not kinetic energy. It needs something else to act upon it. Well, in 2007, 8, and 9, we had a financial bubble that burst and it acted upon it briefly. But the reality is an expensive market, as you can see, can stay expensive for very long periods of time. This first one, the market was above the 80th percentile. It was classically expensive for 17 years. And over that 17 years, while it was consecutively expensive, it returned 230%. The entire time people were waiting for pullbacks, the market got away and returned 230%. Since 2012, we're now 14 years into the market being expensive, and it has returned, as we wait for our pullbacks, even including COVID, it's returned 427%. So a couple big takeaways. When I've got good growth and I've got good earnings, markets can stay expensive, and they can stay expensive for long periods of time. and they can generate really healthy returns while they're expensive. Understanding that should make you committed to whatever your plan is, get it in place. Don't, every week I have a financial professional or two say, "Oh, I just like the market to pull back 5 or 10%." And they wait for that to happen. And if it does happen, they might get it, the market's up 20, and then they get their 10% pullback. Waiting for pullbacks is a very tough business to be in. And I bring that up just with some of the volatility we've seen in the market. Just don't stick to the plan, get invested in the plan, as this chart proves that that's almost always the right approach. So, gentlemen, with that as a couple of comments, let's throw it back to you.
Well, John, thank you so much for your remarks. That was like a master class in dissecting the market. Thank you so much. I think our audience can tell why you're you're in such high demand in terms of your commentary. That was great. So covered a lot of ground there. And as a reminder to our audience, if anyone has a question, please go ahead and raise your hand. We'll unmute you and you can ask away. Um, but what you had started with, John, in terms of the kind of perspective, in terms of sticking to the plan, staying diversified, thinking long term. I mean, I think that just is completely in line with how we kind of go about things here at Mercer Partners. So, that perspective is totally in line. But to that point, I've been getting a lot of questions recently from clients around, particularly in the equity market, because last year we saw a lot of firms kind of driving the market higher, maybe 10 or so. It was a very concentrated market.
Yeah.
I think we've started to see the market starting to broaden out and maybe the, S&P 493, right? Starting to deliver some returns and some good performance. Is that what you're seeing? And how should investors think about, some of the concentration that we've seen in the market in recent years and how that might kind of manifest itself going forward?
Yeah, so I think I reshared a screen.
Yep.
And so I'll go back to that point on potential energy. There's two things historically that are what we have to pay attention to. So number one is valuation,
Right.
and then the other one is concentration. Concentration, we have had peaks, many, many times where a handful, 10 or 15 companies become dominant franchises and overwhelm market returns. What we're going through with the Mag 7 is historically not unusual. It happens all the time.
Mm.
The thing that scares investors is that when we look at what happens to these dominant companies, their success invites competition. Like no one's going to leave NVIDIA alone. They want a piece of that action. And it invites regulators. And so whenever you become a dominant franchise, Washington always believes, well, you must be doing something illegal or antitrust in order to do that. And you can ask IBM, Philip Morris, Microsoft of the past. There's all AT&T. You can ask all kinds of companies when you were at the top of the league charts, what happened to you? And they're like, well, we were happy to compete. It was the government that got in the way of things. And so the chart here on the left basically says if you're a top 10 company, what is the likelihood that you're still in the top 10 5 years later? And what you can see is that on average, there's only 4 of the companies that stay on top.
Right.
6 of them on average are no longer on the top during the next peak. And so competition and regulation is a real force when it comes to thinking about the Mag 7 today. Can Microsoft withstand the pressures of the government, or Amazon, or we all know the names. The other issue, the chart on the right, most people don't, this kind of comes as a surprise. But if I look at my forward returns and this starts to get to the broadening, what ends up happening is because of competition and regulation, these big companies start to underperform. And so you see that the absolute returns of the companies, these 10 largest companies, pretty good. But you start to see that had I been in a more diversified portfolio, my diversified portfolio actually outperformed because these companies are underperforming the S&P 500 years two, three, and out. So there's some tension here, Nick, which is history tells me I need to be careful with market concentration.
Hmm.
It brings returns down. I would argue that no, it's not. What I would argue is that these companies versus 2000 and other prior periods vastly more profitable, significantly better cash and better balance sheets, and not as leveraged. And they are also the driving forces behind AI
Yeah.
and the development. And the last thing, because I do believe the development of AI represents a national security risk, and we're in a race with ourselves and China in particular. China has some very interesting advantages. We have a few other advantages, and so there's a race to develop this. And I think the last thing the United States government should do is go after this company for antitrust and slow down any investment in AI. Let AI get built out, and then give it a few years, and then maybe it's the time to do that. But right now, when you're competing against China, and China is funding this at the government level, and our AI investments having in the private sector, I don't think it would be good policy to constrain these companies right now until we're in a more established position with AI. So I'm a little more, I guess it's a long way of saying I get concerned about concentration, but I'm probably more patient with it right now than I would be in prior cycles.
Yeah. I think that makes sense. You had showed a chart earlier too that just totally astounded me. I think it said 30. So over time, companies are now have a 38% net profit margin
Yeah.
compared to the past. That is astounding to me in terms of how much more profitable companies are today than they have been. And is that in part, John, because of the Amazons and Googles of the world that are just so incredibly, their business models are just so incredibly profitable, that's what we see, that net profit margin from some of those big, tech giants has
Yeah.
increased that. Is that in large part why?
Yeah, so the 38% is obviously the top 10 companies, but
Yeah.
this is also S&P 500 wide. Our profits are better. And just think about it. Every year we take 4% of the S&P 500 and we kick out 4% of the companies. And we're
Yeah.
like, you're not operating well enough. And we replace those underperforming, low profitable companies with higher profitability and less seasonal companies. And so what happens is right now, I think there's roughly it might be only 80 companies in the S&P 500 that were around during the stock market bubble. 420 companies are totally new since 2000. And so what happens is you're constantly upgrading the stock market with better companies
Right.
and kicking out the garbage.
Yep.
And so I'll tell you probably one of the most fascinating things is during April of last year, where everybody thought there was going to be this repatriation of assets. And even right now, like you'll see headlines today, this is the anti-US trade and dollars weak, international equities are doing all these things. During these periods where there's concern about the viability of US assets, we went to our global clients and they were buying US stocks like crazy. And we're like, why are you still buying US stocks? You have plenty of them. And they said, because US companies are different than the companies around the rest of the world. Companies around the rest of the world, they take their cash flow and they pay dividends. You get really attractive yield. US companies take their cash flow, and the Mag 7, in fact, reinvest 57% of their cash flow back into their business, R&D, and CapEx. And then what's left over, they buy their shares back. And so if we're in the middle of a hyper innovative and disruptive period with AI, I want to own US companies that are reinvesting into their business because the landscape is constantly changing. We haven't even seen what quantum computing is going to do to this whole, sector. And so I would say we are in the US, we're also different companies. We don't pay dividends like everybody else. We reinvest in our business, and as a result, in the US, I have 65 tech companies that have net income of at least $1 billion. The next closest country is China with 15
Wow.
companies. Hey, listen, I know Europe's mad at us right now. They only have 3 companies that have tech companies that have net income over $1 billion. And by the way, they're going to be nothing in AI development because they have no power availability. They're not going to be able to run data centers at all. And then the United Kingdom has 1 company so it's like we are a different stock market. We are culturally, religiously, whatever it is, we run companies differently. It gives us a greater likelihood of staying on top, in my opinion.
Yep. And then and Chad, if you have any questions, let me know. But you showed that chart, John, around valuation. And is it toward the end of the
Yeah.
prepared remarks? Is it possible? I mean, because valuation, it has quote unquote been elevated for a long time, right? Compared to historical averages. Is it possible that kind of picking up off your last point there, is it possible that CEOs nowadays are just better at running companies and companies are just more valuable in the sense that they've figured out how to suck cost out of the P&L and just be more profitable. So maybe it warrants, higher kind of valuations to some of the, way companies were run,
Yeah.
before the turn of the century. I mean,
I I
is there
don't
any
know
truth
if
to that perhaps? Or
I mean maybe CEOs are better. I don't know. I think we obviously have more information.
yeah,
So I think we're more informed when we make decisions running companies. Um, but what I think is, again, it gets back to that replacement factor in the S&P 500. I look at, back in the 70s and 80s, the energy sector was 12, 13% of the S&P 500 and had a PE ratio of 8, earnings growth of 3. It was a stodgy, mature sector back then. Um, Today, energy is 2% of the S&P 500. And so like what's also happened is that to your, valuation consistently moves up. The greatest fallacy in our business is that PE ratios are mean reverting.
yeah,
They're
right,
not mean reverting.
right.
And if you keep upgrading the underlying quality of the companies and changing the composition of the S&P 500 to be less cyclical, more growth oriented and less industrial, you pay more for that. All
Yep.
things being equal, you pay more for that. And so year after year, we keep making our stock market more valuable, not less valuable, just by the composition of the companies that are in there. So yeah, I think CEOs are more informed, but I think just the composition of our stock market is superior as well, and that gives higher valuation a better floor to it.
Yep. Appreciate that. And yeah, as a reminder, anyone that wants to ask John a question, you can just raise your hand and chime in. Love to hear from you. Chad, what do you think? Any thoughts?
Yeah, one of the questions that we were, getting a lot of towards the end of the year, and we'll continue to get more of between now and March, is kind of the politicization of the Fed, with Powell's term ending here in 2026.
Yep.
Headlines and that role to play in the underlying health of the stock market as well. So, if you wouldn't mind just kind of giving your opinion on some of the headlines back and forth between the current administration and the Fed, and kind of what direction you think the Fed is headed in with some changes coming this year as well.
Yep. Don't worry about it. Okay. It is the biggest non-story that the media loves to glom onto. The reality is every president has leaned on the Fed. There's no president that does it as publicly as Trump. But when I think of the FOMC, it's 19 participating members, 12 voting members, and of those 12, 7 are appointed by the President of the United States on a rotating 14-year term. Those who are appointed by the president have to be confirmed by the Senate. And so there is a check and a balance. Number one, you have to get, so of the 12 voting members, you basically need to get 7. So let's just do math here. President Trump has Mirren, who's ends at the end of this month. He's been certainly an advocate of the administration. He has appointed Bowman and Waller, but Bowman and Waller have both demonstrated that they are, slaves to the data. They are not political hacks that are doing the bidding of the president, even though they are appointed by the president. They've demonstrated tremendous economic and market soundness in their decision making. So the president right now has to figure out, how do I get to 7? Because just because I appoint a chairperson who might be sensitive to the administration's desires, again, they have to be approved by the Senate, and that's only one vote. The chairperson's vote is no more powerful than any other. And so, functionally, President Trump cannot get to 7 individuals who will do the bidding of the administration. And so, is it directionally? Is it going in the wrong way? Absolutely. We don't want any threats whatsoever to Fed independence. But how close are we to actually jeopardizing Fed independence? Light years. We're light years from that. And it would take Trump with an additional 8 years, and a Senate with 60 to 65 Republicans, so that you could lose 15 Republicans. It's just, there's not the political composition to really do this. So threats to Fed independence, massively overblown risk. I do want to highlight one thing, because there's so much I could talk about here and so many statistics around the election. Do not commingle your political views with your portfolio. Literally knock it off. There is no math that I can show you that will tell me that a certain political outcome leads to a predictable result in the stock market. It does not exist. And we have done exhaustive analysis. Here's the challenge that we're going to have. And what has happened, and we have just seen gerrymandering go up, run amok. And so what we now have is, I go back to the days of Ronald Reagan. And in the days of Ronald Reagan, there were still probably 140 districts in the country that were competitive. So if you wanted to measure the mood of the country, you could see a massive 60 or 70 seat swing in the House in a midterm election. We are now down to the point where we have roughly 16, call a range of 15 to 25 at a max districts that are competitive. And they are shrinking because of all this in California, all these counter gerrymandering legislations where states are going to just lock up and make all of their districts uncompetitive. So even if there's a landslide blue wave in the midterms, that means Democrats probably go to a 3-seat deficit to a 12-seat majority, not a 70-seat majority, a 12-seat majority. We are looking at, because of slim majorities, we are looking at Congresses that are perfectly ineffective at their job for the foreseeable future. Just ridiculous what we're looking at politically. You are not going to have Congresses that can do a darn thing, because if I only have a 10-seat majority, I guarantee in both parties there's 10 votes that you can't count on. And so the parties have a hard enough time getting unified amongst themselves, let alone to overweight the other party. So I would say, get used to messy, thin-margined leadership and presidents who have to live in the world of executive order. And as a result, those executive orders end up in the land of courts. And U.S. politics for the foreseeable future is going to be very messy, very loud, but not any major swings in terms of majorities. The math doesn't exist in the congressional districts anymore.
Good. Well, I think we're coming up, John, to the top of the hour. I think that might be a good place to pause for now. And, once again, thank you so much for spending the time with us today and sharing your insights and your expertise. I know our clients certainly appreciate it. But to kind of summarize your points, right? So stick to the plan, stay diversified, think long term, right? There's going to be volatility, there's going to be ups and downs, but you have a good solid plan, you work the plan, and things are gonna work out. Never bet against America and the capital markets and the power of free markets, right?
Yeah, totally. Go eat some apple pie and hot dogs.
There you go. Thanks again, John.
All right,
Really
guys.
appreciate your time today.
You got it. Bye-bye.
All right. Chad, you want to bring us home, or Don?
Yeah, I'll jump in. So just to echo Nick's comments, just appreciate everybody's time for jumping on today. As always, if you have any questions, things that you hoped that we would get to or didn't, or things that you want to get more in depth into with us, that's what we're here for. So feel free, please call us, email us if there's anything you want to review, or conversations you'd like to have. Of course, that's what we're here for. So don't ever hesitate to reach out. Appreciate all of your times today. And everybody have a wonderful rest of your day.
Thank you, everybody.